Good morning, everyone. This is Ted Bauman here with your Friday Bauman Daily video. This week, I'm going to talk really generally about the focus of my videos here. I think we got off to a wrong foot earlier. I think a lot of people think that this is just a place where we're just going to make predictions on which direction the markets go, and that because I was wrong at the very beginning, which I'll explain now, that basically there's no need to pay any attention. That's fine if your goal is to, basically speculate and gamble. If you got enough money to play with, and you don't need to care about risk, that's fine. You can just snipe from the corners, you trolls, you. But before we do that, I want to say I'm going to switch from my guitar this week to share something else that some of you guys have asked about. I see a lot of you guys from South Asia are asking, do you have a Sunil Gavaskar cricket bat? Yes, I do. This is a Sunil Gavaskar bat that I bought in what was called Bombay when I bought it in 1994. And as you can see, it's done a lot of heavy duty, folks. It's scored a lot of runs. You can see it's just hanging in there. But I keep it around because I love cricket and I just love to remember all the times I've spent out in the middle with my club team in Cape Town, the MCC, the Musicians Cricket Club. Any of you guys watching? I wish I could see you this summer, but I won't be down there. Afraid the flights are not going. Anyway, let's talk first about what's happening in the economy. This chart shows that we suffered a 32.9% annualized decline in GDP in the second quarter of this year. Now, to a certain extent, the market's priced that in. I think it's fair to say everybody knew this was coming. What we don't know is whether the government is going to be able to step in to prevent that from happening again, and maybe not at this same level, but at a big level based on a failure to provide adequate fiscal stimulus. Next chart shows what that means in terms of actual GDP numbers. But the reason I'm showing this chart is to point out that if you look back at the time of the 2008-9 financial crisis, you see that we never really recovered the previous trend line. And that means that GDP figures remain below the previous trend line for the entire period. Now, my prediction is that unless there's a radical change in policy, and I mean government policy, and I don't just mean spending money, but some other things, that's going to happen again. And so we're going to face lower GDP, smaller output, lower growth than we would have seen otherwise prior to the pandemic. Now, what that means is that we won't see a V-shaped recovery. We'll see something like what they call the Nike swoosh. Now, that's a problem because it means that every dollar that is not produced in GDP over many, many years means that the economy is less prosperous. Now, why is that important? Well, it's important because those are the fundamentals that drive companies and their profits, which ultimately in the long term should drive stock prices. Now, I'm going to talk in a moment about why that's not the scenario right now, which is unprecedented. And I understand that that's, essentially what's been driving the stock market. It's what made me wrong about my initial prediction that stocks would see a double bottom. But we'll come to that in a moment. First, I want to show you some charts that show the short-term trend. Top one shows the end of trade yesterday and also into today. We saw a big swing away from the S&P 500, the stock market represented by SPY, and towards bonds represented by TLT. And that's a pretty big jump up for bonds, as you can see. And that reflects a flight away from risk and towards safety. Here you can see in the second chart that really, although bonds have been relatively attractive, more attractive than they were otherwise since the beginning of this year, they are, I think it's fair to say that the trend line for bonds is more strongly up than that for stocks. And why this is important, of course, is because if bonds are already at their highest prices and there's nowhere else for them to go, then that means that effectively they are becoming a proxy for cash. They don't yield anything, they just sit there. The problem is, of course, that bonds can fall in price, whereas cash can only do that if you have inflation. But ultimately, right now, there are a lot of people with a lot of money doing two things. One is putting them into bonds just for safekeeping, and the other is trying to find yield in the stock market. Now, let's look at what's the story in the stock market. Here is the NASDAQ. That little orange line underneath the NASDAQ's level is a 21-day exponential moving average, which I like to use just to see if the market is staying more or less on its course. You can see that the NASDAQ bounced down in June and earlier, basically twice in June. It bounced off the 21-day EMA. And it's done it a couple of days this week, more recently, and today it is trending down. And then you can see the slow stochastic oscillator down below also showing a pretty firm downtrend. It's actually more of a downtrend than we saw in the middle of June, even though we have not yet experienced the a big drop like that one that we saw. However, the signs are there. Let's look again at the Dow, because the Dow represents the real economy. Again, you see the Dow struggling around its 21-day EMA. We see also that the 50-day is looking towards a golden cross where it rises above the 200, but that might not happen, because as you can see also, the slow stochastic is indicating fundamental weakness in the market at the moment. Now, here's another chart that I think shows something very interesting, and that is the percentage of companies in red that are trading above their 50-day moving average. And what's interesting here is that even going into the run-up that we saw in December, January, and March, the percentage of companies that was trading above its 50-day actually fell significantly before the market dropped, okay? Now, we know that the market dropped because of the COVID-19 crisis and really the Fed's announcement that it was preemptively taking all these steps. That's what put everybody into a panic, paradoxically. But I think it indicated that there was some fundamental problems with the breadth of the market even before COVID. Now, if you look on the far right-hand side, you can see that we're looking at that same scenario again. We're seeing a significant divergence between the level of the market as a whole and the number of firms trading above their 50-day. Right now it sits at about 60.74. You can see on the left-hand side. Fundamentally, what that's telling me is that there is accumulating weakness. There are problems with breadth that could or could not lead to a decline in stocks. I'm not going to try to predict that today, but certainly there is reason for caution. Lastly, this chart shows the relationship between or rather the price of gold and the price of silver, represented by proxies, their ETFs. And you can see that despite all the wonderful news we've seen about gold prices and silver prices going up, which is something I've been predicting, we've seen a reversal. And to me, that reversal tells me that people are needing to get cash. Sometimes they need to get cash to cover various bets they've made. Sometimes they need to close margin positions. But fundamentally, that's a sign, it's a clear sign to me that there is something amiss in the market. Typically, when the market is poised for a change, you're going to see people trying to cash out. Now, here's a quote which comes from a guy that is clearly a H.P. Lovecraft fan, just like me. And what he's saying basically is Tesla, has a huge price earnings ratio. So does AMD. And he says really there's one of three things that has to be happening. One is that their prices have to fall, which we know that's not happening because the Fed is boosting them. Their earnings have to grow into their valuations. How can that happen if they're already priced basically to dominate their markets and to make all the profits that are to be had? And three, we need to accept that the Fed has changed the game and revenue growth per share is a greater predictor of stock prices than profits. It looks more like number three is true, and when we have these big game changing, it's different this time, new economic models, it just turns out to be a bubble, which brings us back to number one. Thank you, my friend. I think that's a very, very wise thing that you said, and this is exactly my point. My newsletter, and most of the people who subscribe to my newsletter are people who are interested in growing their wealth. They're not interested in gambling. They're not interested in speculative bets. They're not buying Kodak, even though current valuation for Kodak reflects an assumption that they will make about 10 times the potential revenues that a manufacturer of generic medicine inputs can make. That's not the kind of thing we're doing here. We're basically trying to make money at a reasonable risk profile. And I think this is where the disjuncture comes. A lot of you guys, a lot of the trolls out there, who like to pile in and basically start commenting on the videos even before we run the video, because you're basically pegging us as perma bears. You're saying, we're always wrong. But we're not always wrong. my Alpha Stock Alert portfolio, for example, my Bauman letter, which you could subscribe to up here. We're beating the market by about 6-1 this year, folks. What else do you want? And we've had very, very few drawdowns. I bet a lot of the people who, are criticizing us can't say that. That's my point. We're doing it, not just on the basis of price, but also price versus risk. And here's why I think that's important. First of all, the goal of what we do is to try not just to make a return on our money, but get the return of our money. We want our money back. So we're not willing to take huge risks. We want to earn a yield, but we don't want to do it in a way that risks losing our principal. Now, in the long run, when you try to do that, asset allocation matters much more than time in the market, or timing markets rather. As Warren Buffett said, who everybody likes to diss and say he's over the hill, etc., he said, the stock market is a device for transferring money from the impatient to the patient. Now, that's my strategy. Okay, if you are really one of these gung-ho guys who thinks that the market only goes up and you're willing to disregard risk, and you think you should throw everything at the wall immediately, every time there's an opportunity, fine. But this is not really the channel for you. And I appreciate you coming in, but let's not talk at cross purposes, shall we? We're here to try to do what I've just said, which is to return of our money as well as return on our money. Now, my goal is always to have a mix of assets that offer some protection against a downside in the market, but also, to provide some yield, just like everybody else. Problem is that in a zero rate interest rate world, that has really made everything very difficult. And here's why. First of all, before this whole crisis started, my approach was that stocks would outperform cash, bonds would be portfolio protection in a downturn, and that you could basically get inflation hedging and some yield, mainly through real estate investment trusts, because real estate has intrinsic value. Now, what's happened since then, with the Fed having pushed things down to this zero rate scenario, is that number one, it takes Treasury bonds out of the equation. Basically, Treasury bonds can't go any lower than they are. They could, but they're at 0.5. Are we really going to see negative interest rates? Is that the likely scenario here in the United States? I don't think so. I don't think the Fed will see that happening. But they really can't go any lower than they can in terms of yield. That means that their prices are as high as they can go. Now, bonds can still fall in price if, for some reason, people start taking money out of bonds and into stocks. But right now, they are priced to perfection, if you like. The second thing that happens is that it makes gold relatively more attractive, because gold is basically like cash that you can't print. If it's right now, there's a toss-up between bonds and gold. If you're not getting any yield on bonds, you might as well buy gold, because at least the chance that gold is going to fall in price isn't as great as the fact, or the possibility that bonds will fall. So really, essentially, people are piling into gold as a store of value, and that's why we've seen its price rise. That's why I recommend it. Third, as we know, and this is really the fundamental thing, and again, it's something that I underestimated back in March and April. Essentially, it's TINA, right? It means that there is no alternative. There is nothing else out there that can replace owning stocks if you want yield. Now, the problem is that makes the stock market fundamentally unrelated to the underlying economy. And I think essentially that's what my friend out there, whose quote I just read, is saying. He's saying, look, right now people are piling into the stock market because it is the safest asset in terms of yield. It's the only asset that is providing any yield. And it's doing that because effectively we have created socialism for asset markets. That's what the Fed has done. Now, I accept that. I get it. It offends me as a fundamentalist. It offends me as an economist, and really it offends me as a citizen, because I think really what it means is that we have created a tremendous bubble in assets and we've also created an expectation that it will never be allowed to deflate, that the Federal Reserve's job is to prevent that from happening at all costs for all time going forward. That's not a stable scenario. And effectively, I think that's why, to return to my initial point here, the critical question is, if you are concerned about risk and you're concerned about moderating risk, then you need to do more than just be gung-ho about stocks going up. You need to understand why they're going up, what the background is, And you need to recognize the fact that it's an extremely risky situation. When stocks are the only game in town, then you do have this possibility of reversals. Now, I'm not saying we're headed for a reversal right now, but I do think that the signs are pointing in that direction. And I think it's because we have reversed course in terms of economic recovery. We don't have a clear path forward when it comes to the stimulus package that's going to come out. We're facing a monumental election in November. We're also facing the possibility of political instability surrounding that election and its legitimacy. All of those things are bad for stocks, folks. So, to return to my initial point, the Bauman Letter, Bauman Daily, this channel is for people who want to manage their risk and make good trade-offs, who are interested in getting a return on their money, but also a return of their money. And if that's not what you're after, feel free to unsubscribe. But I think most people here are looking for a way to do that. And I said a Bauman Letter does provide that. Anyway, that's it from me for this week. I hope you heed the words of my friend Frank Zappa, because that's what I try to do every day. Take care.